Good evening, everyone. So we'll continue from where we left in the previous session, and now we'll move on and understand aspects around derecognition, what happens when there is a disposal, loss of control, and all of those related aspects. So far, we have covered how to do a basic consolidation. Then we have talked about intercompany transactions in detail. We have seen how do we eliminate profits on inventory and all of those aspects. Then we have also seen chain holding. Chain holding, very, very important from examination purpose because calculations sometimes can be tricky. Just give me a moment. Yeah, if you're there. Okay. Now, the next aspect what we need to understand is loss of control over subsidiary. Now, what is the meaning of loss of control? See, if for example A acquires 80% stake on B of B. So A controls B, and when A controls B, what do we say? A is the parent, B is the subsidiary. Now, for example, A sold 40% stake to outsider or 30% stake to outsider. Out of this 80%, A sold, let us say, 40% stake to somebody else. Now, after that sale, A holds only 40% stake in B. Now, does A control B? See, when A had 80%, we said A controls B. But now when A has only 40%, it is possible that A has sold these shares to some third party C. Now, can we say A controls B? We cannot say A controls B because stake is less than 50%. And assuming no other condition of controlling the composition of board of directors and all of those things are not met, A does not control B. Now, what happens is there are two financial statements. One is your standalone financial statement, or we also refer it to as separate financial statement. Then we have consolidated financial statement. We have two financial statements, standalone and consolidated. Now, in the standalone financial statement, A would say, I have investment in B. In the consolidated financial statement, because A controls B, what we have is net assets of B, right? Assets and liabilities, and we have NCI of B. Now, once the control is lost, what we need to do is we need to eliminate or we need to derecognize the net assets and the NCI from the balance sheet of B. Also, in the balance sheet of A, in the standalone, sorry, not in the balance sheet of B, in the consolidated balance sheet. Also, in the standalone financial statement, whenever we dispose of investment, there will be gain or loss that will be recognized as per our Ind AS 109. Whereas in the consolidated balance sheet, because I no longer am holding the stake in B, what do? I derecognize the net assets of B, and I also need to derecognize NCI. Against this, whenever I sell a stake, whenever I transfer a share, I receive some consideration, right? So, for example, when the entity sold 40% to outsider, they would have received cash. So, cash will be increased in the consolidated financial statement. So, in summary, whenever control is lost, what do? We derecognize the net assets, we derecognize the non-controlling interest, we see how much of consideration we have received, and the balancing figure will be profit or loss in the consolidated financial statement. Then In the standalone financial statement, we will do normally what we recognize, how we account for a normal sale of investment. Okay, so all the consolidated assets, all your goodwill, other assets of B, other liabilities of B, and NCI pertaining to B, all of these will be removed, and you will bring in one more component. Let us say cash is received, you will recognize cash. If cash is not received, if something else is received, you will recognize that. Sir, cash is also not received, anything else is also not received, but still we have lost control. Now that is possible when A holds, let us say, 80 shares in B. B issues and 20 is held by NCI. What B does is B issues 200 shares to C. B issues 200 shares to C. Now, when B issues 200 shares to C, A no longer controls B. A no longer controls B. So here also you will de-recognize the net assets, goodwill, and whatever is the balancing figure. That balancing figure will be the loss which will recognize on loss of control. Let us take some examples. So I am taking illustration number 25 from the study material. A Limited purchased 100% subsidiary for rupees 10 lakhs. Fair value of subsidiary B is 8 lakhs. Which means what? 10 lakhs is what we have paid. Fair value, that is the net assets, is 8 lakhs. So the difference of 2 lakhs is goodwill. Okay, now say for example, if A sold 60% stake to outsiders for, let us say, rupees 15 lakhs. For rupees 15 lakhs, when net assets of subsidiary is 20 lakhs. Now, what has happened? Initially, A acquired 100% of subsidiary for 10 lakhs. Fair value of the subsidiary is 8 lakhs. 2 lakhs is goodwill. So, in the balance sheet, you will have goodwill of 2 lakhs, which comes from the subsidiary. In the balance sheet, you will have goodwill of 2 lakhs, which comes from the subsidiary. And on the date of sale, the net assets is how much? 20 lakhs. On the date of sale, the net assets is how much? 20 lakhs. Right? Now, how much is NCI? NCI is 0. How much is NCI? NCI is 0. And also remember that whatever is the portion where when you sell, this net assets should be de-recognized. $20 lakhs of net assets. Then you will also de-recognize goodwill of 2 lakhs. You will de-recognize net assets of 20 lakhs. You will de-recognize goodwill of 2 lakhs. Now, apart from that, is there anything we need to de-recognize? Liabilities is already included in net assets. So, these are the two components that will be de-recognized. Apart from that, is there anything else we need to de-recognize? So we will de-recognize these two items. And how much have we sold? We sold 60% stake. We sold 60% stake to outsiders, which means we retained 40% stake. So this 40% stake of, let us say the fair value is 20 lakhs. Fair value is 20 lakhs. 40% of 20 lakhs will be recognized. So what are we saying is, from the balance sheet, consolidated balance sheet, the entire net assets, entire 100% of net assets will be removed. Entire any cash received, that will be added. Any NCI, that will also be removed. But because we continue to hold 40% of stake, that 40% of stake will be recognized afresh. The 40% stake will be recognized afresh. So we will de-recognize all the assets, goodwill, liabilities, any non-controlling interest, whereas we will recognize whatever stake we retain. So here what will happen is, debit cash 15 lakhs, we have received 15 lakhs of cash. Debit investment at fair value retained, let us say 8 lakhs. Credit what? Net assets 20 lakhs. Credit goodwill 2 lakhs, whatever was recognized. So 22 and 23, the difference is gain. So the difference will be gain on disposal. See, even if we have not sold 100% of the subsidiary, the moment we lose the control over subsidiary, we will say there is a gain or loss on disposal. Is that clear? Okay, that is clear. Now, sometimes what happens is, there is a sale, but control is not lost. There is a sale, but control is not lost. What does that mean? It means that we have sold certain stake, but control is not lost. For example, if A sells 20% stake in B, A has sold 20% stake in B for, let us say, 100 lakhs. Okay, but control is not lost. Control is not lost. 100% was held initially. Now we have sold 20% for 100 lakhs. Now on this date, the net asset of subsidiary is 300 lakhs. This includes goodwill of 65 lakhs. Now, how do we account for this transaction? Now see, in this type of transaction, when control is not lost, now see the balance sheet. In the consolidated balance sheet, when control is not lost, whether it is 100% consolidation or whether it is 80% interest held, what value or what percentage of subsidiaries net assets do we consolidate? When we consolidate 80% or when we consolidate 100%, say for example, plant and machinery, 100 crores. Okay, at 100% versus 80%, what is the value we consider for consolidation? Whether it is 100% or 80%, what is the amount we consider for consolidation? We consider entire 100 crores. My asset addition from with parent and subsidiary does not change. My asset addition between parent and subsidiary does not change at all. So the net assets that I have will not change. So the net assets will remain same. The net assets will remain same. So then what will change? Something that will change is I will get a new component called NCI, the non-controlling interest. This 20% will now be a NCI in my books. So whenever I am selling a stake without losing control, I have to recognize non-controlling interest. Then when I sell stake, I receive cash. So I will debit cash. So how much is cash? Cash is 100 lakhs. How much is NCI? 300, 20%. NCI is 60. The balance component is classified or kept under other equity of 40. Because I got 100, but I am giving away rights of only 60. I got 100, I am giving away rights of only 60. So the differential portion will be not debit, sorry, credited to other equity. So two aspects. When there is sale or when there is loss of control. If there is loss of control, you will debit cash, credit assets. You will also debit liabilities, credit goodwill, debit NCI. Balancing figure will be your gain or loss. If there is no loss of control, then what do? We will debit cash, credit NCI, balancing figure other equity is where we transfer, right? So that is how we handle cases where control is not lost. If control is lost, then the differential portion will be recognized as gain. Just give me a moment. I'll pull out one question. I'll share the screen directly. This question, very interesting one. When there is a loss of control, but there is no transaction or there is no, consideration that is flowing into. Okay. In March year 1, a group had 60% interest in subsidiary. When we have 60% interest means we control the subsidiary. With share capital of 50,000 ordinary shares, the carrying amount of goodwill is 20,000 at March year 1, calculated using the partial goodwill method, means the proportionate method. Fair value is full goodwill. On 31st March, an option held by the minority shareholders exercised the option to subscribe for a further 25,000 ordinary shares in the subsidiary at 12 per share, raising 3 lakhs. The net assets of the subsidiary in the consolidated balance sheet prior to the option exercise were 4,50,000 without goodwill. So without goodwill, net asset is 4,50,000 before exercising the option. After exercising the option, the net assets will go up because the money has been received of 3 lakhs. Calculate the gain or loss of interest in subsidiary due to option exercised by minority shareholders. Now, how much did we hold initially? We held 60% of 50,000. That is 30,000. 60% of 50,000, that is 30,000. Now, 50,000 plus 25,000. What is the total stake? Total after issue is 75,000. Now we hold only 30,000 out of 75,000. So if you see 30,000 divided by 75,000, we get 40%. 40% means what? We lost control. 40% means what? We lost control. When we lose control, then what do? We de-recognize the net assets. We de-recognize the net assets. We recognize the fair value of any investment retained, because in our balance sheet we still hold 30,000 shares. So this 30,000 shares at fair value we will still continue to recognize. We will de-recognize any net assets. Okay. So now, before it was 30-20, after it is 30-45, which brings it to 40% and 60%. Now, before the reorganization, if you see, out of the total net asset 450, out of the total net asset 450, 270 was group share, which is 60%, 450 into 60%, and 40% is other party share, which is 180, that is your NCI. After reorganization, what happened is the group share became 300. Sir, how did the net asset increase? The net asset increased because 450 plus 3 lakhs. 450 plus 3 lakhs. So 450 plus 3 lakhs, when you do this amount that has been raised, it will increase the net asset. Whenever I issue shares, my net asset will increase. Why? Because I receive cash. Because I receive cash, my net assets will increase. So my net assets revised number is 750, out of which group share is 300 and other party share is 450. Right? Now, how do we calculate the gain or loss? What is the fair value of interest retained? What is the fair value of interest retained? Fair value of interest retained means what? We have 30,000 shares. That 30,000 shares is valued at 12. So what we will do is, we will debit investment at 360. Means we will recognize investment. See, whenever we prepare consolidated financial statements, we de-recognize or we don't show the investment in subsidiary. Now, anyways, it is not a subsidiary, but you will debit investment by 360. Right? Then you will de-recognize the net assets. How much of net assets? 450. Why 450? Because that is the amount, or this is the total net assets before the exercise. See, after the exercise we have lost control, so these numbers are not relevant. Before the exercise, the assets that would have been consolidated is 450. The asset that we would have consolidated is 450 before the exercise of the option, right? 450. So you will credit net assets 450. Then you will credit goodwill. How much is goodwill? Goodwill is 20,000. You will credit goodwill. Then non-controlling interest also you will de-recognize. So what is NCI? NCI value is 180. So you will de-recognize NCI. You will debit NCI at 180. So 180 plus 360 minus 450 minus 20. 180 plus 360 is how much? 3 plus 1, 4, 540 minus 450 and 20, 470. So 540 minus 470, what you get is 70. So this is the gain on the disposal. Again, I am repeating. First, we will recognize our investment, whatever we have retained, 40% interest at 12 rupees per share. As assumed basis that 12 is the fair value. Then we will de-recognize net assets 450 because entire the subsidiary will no longer be consolidated. So we will de-recognize this, and we will show, or we will de-recognize NCI portion, which is 180. Sir, is it not double counting? It is not double counting because asset side 450 we are eliminating and NCI side 180 we are eliminating. Okay. In basically we are saying the group's ownership we are eliminating. Okay. Then Goodwill will eliminate 20. The balancing figure 70 is the loss on disposal of subsidiary. Any questions? Let's look at this illustration 32. I need to plug in the charger. Just a moment. Let's have a look at the next question. Partial disposal when subsidiary becomes an associate means earlier it was a subsidiary, let us say greater than 50%. Now it has become an associate. Associate will understand subsequently. This is where you have significant influence. You have significant influence. There is no control, there is significant influence. Okay. A Limited purchased 100% subsidiary for 50 lakhs on 31st March of year 1 when the fair value of the net asset of BT Limited was 40 lakhs. So subsidiary net asset is 40. Now 50 minus 40, 10 lakhs is goodwill, right? So goodwill is 10 lakhs. AT sold 60% of its investment in BT Limited on 31st March of year 3 for 67 lakhs 50,000. Leaving AT Limited with 40% and significant influence means now it will become an associate. At the date of disposal, the carrying value of net assets of BT Limited excluding goodwill is 80 lakhs. So we will recognize 80 lakhs. Assume the fair value of the investment in associate BT Limited retained is proportionate to the fair value of the 60% sold, that is 45 lakhs. So whatever is the value that you have retained, that value is how much? That value is your 45 lakhs. Calculate the gain or loss on sale proportion of BT Limited in separate and consolidated financial statements. So now here we have separate financial statements and also consolidated financial statement. Separate financial statement means what? In its individual financial statements, it has invested at what value? 50 lakhs. It has invested 50 lakhs. Now 50 lakhs is for 100%. We sold 60%. So our cost is how much? 30 lakhs. This cost you compare with the sale proceeds. 67 lakhs 50,000. So 6750 minus 30, you get 37.5 of gain. This is in the standalone financial statement. Like normally what you would have done, sale proceeds minus cost of investment. That is what you will do in the standalone financial statements. Okay. Now, that's the first aspect. Second, in the group. Now in the group, what do we need to see? In the group again, I will just broad recap what we understood. We will debit cash received. See, in the exam you can prepare in the tabular format, there is no problem. But this structure once you remember, we have received cash, we have de-recognized asset. When you follow that structure, you will remember. Otherwise, remembering table becomes sometimes difficult. So we will recognize cash. So debit cash. How much? 67.5. That's the first thing. Second, what is the fair value of investment retained? So here the fair value of 60% sold, based on fair value of 60% sold, 45 lakhs is retained. So fair value retained is 45 lakhs, right? You will debit that. What will you credit? You will credit net asset. How much is the net asset? 80 lakhs. You will credit goodwill, which is 10 lakhs. Then will we de-recognize any non-controlling interest? Now in this case, it is a 100% subsidiary. When it is 100% subsidiary, non-controlling interest is 0. So there is nothing that we need to de-recognize, right? So this is the impact. Debit, debit, credit, credit. So 67 plus 45 112.5 minus 90, you get 22.5 of gain in the financial statement. So this is how we calculate when there is a sale. Now here it has been sold, some stake is retained, and this 45 will be accounted for using the equity method, which we will understand subsequently. Now sometimes what happens is we purchase also. So that also case, let us see. Additional stake purchased. Just a moment. Sometimes there may be acquisition of stake. So sometimes there can be sale of stake. Now there can be acquisition of stake, which is already a subsidiary. Means you already are consolidating 100% of net assets. You already are recognizing some non-controlling interest. Now we are acquiring more stake. So entity A acquired 60% of entity B 2 years ago for 6,000. So this is already done in the past. At the same time, B's fair value was 10,000. So acquired for 60% 6,000, fair value 10,000. So there is no goodwill. Why? Because 60% 6,000 means 100% is 10,000. I think some number is missed here. B Limited had, this is, I think B Limited had assets with a fair value of 6,000. So okay, this is something else. Net assets with a fair value of 6,000, which is assumed to be the same as the book value. So basically what they are saying is 6,000 is fair value. 6,000 is fair value of net assets. Okay, and B's fair value was 10,000. B's fair value was 10,000, and so if 6,000 is the fair value of 100%, NCI is how much? 40%, which is 2,400. NCI is 2,400. Now, how much did we pay? We paid 6,000 plus, this is the purchase consideration, plus NCI 2,400. That brings us 8,400. This 8,400 is the total payment side. Fair value is 6,000. So goodwill is 2,400. So that is again calculated and given to us. On 1st October, entity A acquires a further 20% interest in entity B, taking its holding to 80%. At that time, the fair value of entity B is 20,000 and entity A pays 4,000 for the 20% interest. At the time of purchase, the fair value of entity B's net asset is 12,000 and the carrying amount of non-controlling interest is 4,000. Now, what you need to understand is, in this kind of scenario, when additional interest is acquired, right? Now, when additional interest is acquired, does it change the control proposition? It doesn't change. The control position does not change. A was controlling earlier also, A is controlling now also. So control does not change. What changes? Understand this. Earlier, A was holding 60%, NCI was holding 40%. A was holding 60%, NCI was holding 40%. Now what happened? 20% moved from here to here. So basically, now this 40% became 20% and this 60% became 80%. That is the difference. Okay, that is the difference. Now, is there any change? Is there any change in our control? There is no change in our control. We are controlling. Of course, stake has changed, but control doesn't. Control is there. Control was there. Control exists. So control doesn't change. So no recomputation of goodwill and all of that. So what do? We have to de-recognize this NCI. See, NCI right now we are showing at how much? NCI we are showing at 4,000, which is the question says is the carrying amount of NCI. Now this NCI 4,000 represents 40%. I need to say for 20% how much is the NCI? It is 2,000. So now out of this 4,000, 2,000 has to be eliminated. NCI has a credit balance. So what I will do? I will debit NCI by 2,000 because I have to eliminate it. Then I have paid 4,000 to acquire. So I will credit cash 4,000 and the balance will be recorded in other equity 2,000. There is no need to calculate your further goodwill and all of those things. Any question? Goodwill is not adjusted. Please keep that in mind. Goodwill is not adjusted. Please keep that in mind. Goodwill continues to be remain to be recognized as it is. Okay. So that is the aspect related to your acquisition and acquisition of additional stake and disposal of stake when control is lost and when control is not lost. Right. Now we have understood the practical aspects of consolidation. Now we'll move to some theoretical aspects or theoretical concepts, again important from examination point of view, which will help us understand whether there has to be your when should we consolidate, what are the exemptions of consolidation and all of those things. That is what we'll be understanding now. Any questions so far? No questions? No, so see, goodwill is always calculated on the acquisition date. After acquisition date, what happens? That will not impact the goodwill. See, post acquisition, the NCI balance also changes, right? Because of your interest, because of your not necessarily post acquisition share of profit and all of that. Your this will change. The NCI balance will change, but that doesn't mean that we will have your recalculation of goodwill. So recalculation of goodwill does not happen. So now we'll understand the theoretical aspects. Quick summary of how to account for consolidation or how to prepare the consolidated balance sheet. We have done enough number of questions, right? Now when we prepare the consolidated balance sheet, we simply add all assets and liabilities. Then eliminate intragroup transactions. Then equity share capital of subsidiary and investment of parent company are eliminated. Parent share in post acquisition profit of the subsidiary are added to the account of the parent company. That is very simple aspect, right? Now some theoretical aspects which we have not covered earlier, that is what we will be discussing now. Now these theoretical aspects are basically related to exemptions and control related definitions. Now if the following conditions are satisfied, an entity need not present consolidated financial statement. Now this is very important. Sometimes question may come in the examination that okay, this company does not want to prepare consolidated financial statement. Is the management opinion correct or not? Right, something like that. Now, what are the conditions? It has to meet all of the following conditions. First, the entity is a wholly owned or a partly owned subsidiary of another entity. Of course, either it will be a wholly owned subsidiary or a partly owned subsidiary. And all the owners of the entity are informed and they do not object to the entity not preparing consolidated financial statement. So, either I am a 100% owned subsidiary, which means there is one another owner. That owner says, I don't want to prepare consolidated financial statement, or there is a partly owned subsidiary, less than 100%, and all the owners of the entity are informed, meaning to say, if for example, you have A holds 80% in B, 20% is held by NCI B. Now what B has to do is, it has to inform all its owners. So generally what happens, A will decide, B, you don't prepare consolidated financial statement, auditing is costly, preparation of account is costly, don't prepare. So B has to inform all its owners and they should not object to the entity not preparing consolidated financial statement. So this is the first condition. Inform the owners, they should not object. Second, the debt or the equity instrument of the entity are not traded in public market. Basically, they are not listed. Debt or equity instrument of the entity means the subsidiary are not traded in the public market, whether domestic exchange or foreign exchange, whatever it is. Then, the entity has not filed nor is in the process of filing its financial statement with any regulatory agency, something like SEBI, for the purpose of issuing any class of instruments in the public market. Okay. So first, tell all the owners, we are not preparing consolidated financial statement. Second, you should not be listed, otherwise SEBI will not allow. You should not be in the process of listing. Okay. And third, and very important, last one, the entity's ultimate or any intermediate parent produces financial statements that are available for public use and comply with Ind AS. Means what? The last one says, A, if for example, A says, B, I will not consolidate. I will not consolidate B. Now what should happen? I should be having A or any other parent. If A has another parent, their consolidated financial statements, the entity's ultimate or any intermediate parent produces financial statements that are available for public use and comply with Ind AS. So basically, here B, here we have A. A says, I will not prepare consolidated financial statement. Okay. Let us say there is one more guy on the top, Z. Z has to prepare consolidated financial statement as per Ind AS, in which it will, take into account the entire group. Then, in which subsidiaries are either consolidated. So here Z will consolidate A and B, or they are measured at fair value through P&L. So Z will say my investment in subsidiary is measured at fair value through P&L. That again there is a subsequent discussion on that. That is where we will understand. In some cases where you will measure at fair value through P&L without consolidation. Okay. So if these four conditions, number one, it's a subsidiary, wholly owned or partly owned. You have told all the owners. It is not listed. It is not in the process of being listed, and the entity's ultimate or any intermediate parent means ultimate Z, or there is somebody else Y. Someone prepares consolidated financial statement which includes all the subsidiaries, either consolidation or fair value through P&L method. Okay. So in those cases, you are not required to consolidate. Similar exceptions you will see in Companies Act as well. Also, post-employment benefit plans or other long-term employee benefit plans to which Ind AS 19 applies, you don't need to consolidate. So sometimes what happens is, let us say there is a company, BPCL, it has a trust for PF. Technically, BPCL controls this trust, means indirectly, but this need not be consolidated. Then, an investment entity that is required to measure all of its subsidiaries at fair value through P&L did not present consolidated financial statement. So if it is an investment entity, the purpose is to get the money, invest, If that is the case, then the investment entity is not required to consolidate if it measures all of its subsidiaries at fair value through P&L, right? So these are, if these 4 conditions are met and these 2 exceptions, you don't need to consolidate. Now, what is an investment entity? An entity is an investment entity if it fulfills the following condition. Obtains fund from one or more investors for providing those investors with investment management services. So basically, there are investors. From all of these investors, this investment entity receives money. They collect fund. And what do? They provide investment management services. Then commits to its investors that its business purpose is to invest funds solely for returns from capital appreciation, investment income, or both. Okay, so investment entity is saying to all its investors, give me money. Okay, what will I do? I will provide investment management services. I will invest in other companies. What will I get in return? I will get capital appreciation, or I will get maybe dividend income or interest income, as the case may be. Then measures and evaluates the performance of substantially all of its investment on a fair value basis. So for an investment entity, for someone to be an investment entity, to fall into this particular category, it has to collect money, provide investment management services, return of income by way of capital appreciation or investment income. It is not in the business, it doesn't operate businesses. Okay, then it measures the performance of substantially all of its investment on fair value basis. Then it can be called an investment entity. Now, there is an exception. An entity is not an investment entity if the entity or another member of the group containing the entity obtains or has the objective of obtaining other benefits from the entity's investment that are not available to other parties that are not related to investee. Now, this is where it becomes slightly complicated. Let us see what does it mean. If there is an investment entity, this investment entity collects money from various people, and what is its objective? Its objective is to manage that investment and earn capital appreciation or any other return on investment. That is its objective. Okay, now if it is an investment entity, you will not consolidate if it follows the fair value basis of valuing its investment. But say for example, this investment entity, so here what is the question, what does the standard say? An entity is not an investment entity. So what did we say here? We said an investment entity that is required to measure all of its subsidiaries at fair value through P&L need not present consolidated financial statement. So if this investment entity has multiple different investments, A, B, C, investment entity has investments in A, B and C, this need not prepare consolidated financial statements if it measures all of its subsidiaries at fair value through P&L, because it is just managing it as an investment. But if the investment entity or another member of the group containing the entity, meaning to say this investment entity, or let us say this entity, A and B, they have some arrangement because of which they get some licenses. So basically, say for example, there is this investment entity which has collected money from various different shareholders. This has subsidiaries A, B, C. Let us say A has the brand McDonald. A owns the brand McDonald, and what A does is A gives this brand to B on license basis. So McDonald brand can be used by B also. McDonald brand can be used by B also. Now here, apart from this investment philosophy, there is some kind of indirect business related transaction or benefit that is available to B. Or another case could be A owns coal mines and all the coal of A is supplied to C. Again, there is some kind of business transaction. If these kind of structure is present, then this investment entity cannot claim the benefit of being an investment entity. You may say, sir, we have collected money from the shareholders. We are only managing investment. But indirectly here, some business is being managed. So, investment entity related exemption will not be available. So, the second, the exception is if the entity obtains, if entity or another member of the group containing the entity obtains or has the objective of obtaining other benefit from the entity's investments that are not available to other parties that are not related to the investee. Means outsiders will not get, insiders will get. For example, acquisition, use or exchange of processes, assets, technology. I have certain assets, inventory, mines, I will give it to my group company. Or some other form of joint arrangements or other agreements between the entity or another group member and an investee to develop, produce, market or provide products and services. Some form of joint arrangement has been entered into. Is that joint arrangement available to outsiders? The joint arrangement is not available to outsiders, right? Similarly, there could be, for example, transactions between the entity or another group member that are on terms that are unavailable to unrelated parties. Huge discount or favorable market conditions, favorable credit period, some kind of benefit is derived by other entities. In that case, the entity cannot claim the benefit of being an investment entity. So, quickly, if all these four conditions satisfied, wholly owned subsidiary or partly owned and informed all the owners, then already listed or in the process of listing, then ultimate parent or any intermediate parent prepares consolidated financial statements as per Ind AS, which is available to the public. If these conditions are satisfied, consolidation is not required. Then for Ind AS 19 employee benefit plans, consolidation is not required. And for investment entity that is required to measure all of its subsidiaries at fair value through P&L need not present consolidated financial statements. I'll just need a 2-minute break to charge the pencil iPad. Any questions so far? So this exceptions or exemptions from preparing this is more important from theoretical perspective. Okay. Now, moving on, evaluation of control. See, whenever we have to prepare consolidated financial statement or when we talk about business combination, there is an evaluation of control. Only when one entity controls the other entity, there comes the question of consolidation. When does an entity control another entity? Entity controls another entity when all the three conditions are satisfied. Power. So, we are looking at investor and investee. Investor controls investee if investor has power over the investee. Power means what? Power means I will tell the investee what to do. I will take decisions for the investee. I will decide what the investee has to do. So that is what is called power over the investee. Okay. Then because of this power of over the investee, or generally also they have exposure or right to variable returns from the investee. Now what is the meaning of variable return? Variable return means that my return from the investment is not fixed. For example, if RIL makes investment in Geo, the return is variable. The return is variable, and because of this power, please understand, RIL must have power over Geo, and it must have variable returns. It is either having a right to variable return or it is exposed to variable return. Then it has the ability to use the power over the investee to affect the investor's return. So RIL has power to affect this return. How will it affect the return? It will take decisions, expansion decisions, or we will give everything for free. When you give everything for free, then also your returns are affected, correct? Or when you give discounted price, when you expand in the market, when you acquire another competition in the market. So there is a power, there is an exposure or right to variable returns, and I can use the power to affect the return. I can use the power to affect my return. For example, if I control or if I own a particular business, okay, I have power over the business. Yes. What am I exposed to, or what do I have a right of? Variable returns. Then because I have right to variable returns and I have the ability to use my power, I have the ability to use my power to impact the return. See, the return can be profit, the return can be loss, the return can be anything, but I have the ability to use my power to impact the returns that is being earned or that I will be accruing. Right now, how do I get the power over investee? So there are three components which you need to remember: power, variable returns, ability to use the power to affect the investor's return. Right now, once you have these three, then each item, how do we have power? Power, if an investee has existing right that give the current ability to direct the relevant activities of the investee. So again, I must have existing rights, not future rights. I must have existing rights. With the existing rights, I have the current ability. I must have current ability. Whether I want to exercise the right or not is different. I have current ability to direct the relevant activities. Now, what are these relevant activities? These relevant activities are those activities which will generate return. Relevant activities are those activities which will generate return. So, I have a right, ability, that gives me ability to direct the relevant activities of the investee. Now, what are relevant activities that significantly affect the returns? For example, selling goods, managing financial assets, disposing of assets, R&D, and all of those things. So basically what I am saying, Reliance has power over the investee. How do I know it has power? It has existing rights that gives it the current ability, means currently it can direct the relevant activities. Give everything for free for 3 months. That impacts the return of the investee. Then, how do we get power over an investee? Generally, maximum cases, voting rights greater than 50%, or potential voting rights, means I have options. If I exercise the options, I can get the voting rights. Whether I want to exercise or not, that is a separate question, but do I have the potential voting rights? Then, right to appoint, reassign or remove the members of investee scheme management personnel who have the ability to direct the relevant activities. Basically, let us say board. I can appoint members on the board, I can fire members on the board. So, this is the second one. Then, right to appoint or remove another entity that directs the relevant activity. Meaning to say, sorry, meaning to say, there are two parties. This is the third party. Okay. Currently, B is directing. Right. A has the right to remove B. A can say, B, you get lost, I will manage the entity. So if such kind of rights are there, then also I get the power. Or right to direct the investee to enter into or veto any changes, transactions for the benefit of the investor. So as an investor, I will decide what benefits me, and accordingly I will take decisions. So that is the next aspect. Then any other right which will help me to gain some control over the investee or some power over the investee. So that is how we will determine the power. Now, we also need to understand substantive versus protective rights. Similar things we have understood in Ind AS 116 also. Substantive versus protective rights. Some rights are protective in nature. Protective means these are only to protect the interest of the investors. that may not be actively exercised by the investor. For example, a right exercisable by an investor only in the event of fraud or default by other investors having power to take decisions. Okay, so you have Geo, you have RIL, and let us say Suraj. I'll give my name. Okay, now RIL is currently directing Geo. I will have power or I will get control only if RIL defrauds or RIL does some fraud, or here some fraud happens, then I get the right. Now that right is not substantive right. Today I cannot exercise the right. I do not have the current ability. I do not have the current ability to exercise the right. Then when will I have? I will have in the future when some event happens. So that is not a right which gives me power. Or a lender's right to appoint a nominee director on the board to ensure that the borrower do not engage in activities that significantly increase the credit risk. This is again a protective right. This right gives protection to the lender. The lender is not interested to manage the business of the enterprise. That is not the interest of the lender. What does the lender want to do? The lender wants to appoint just to protect its interest. Okay. Similarly, rights held by minority shareholders to approve decisions related to capex greater than required in the normal course of business. So, minority shareholders may have some veto right only in case of some specific decision. That also does not give them control. Okay, so the rights which are protective rights, they do not give investor power over the investee. So investor will not have power over the investee because of these particular rights. Generally, substantive rights come from voting rights, and substantive rights give the investor power over the investee and relate to the relevant activities of the investee. Also, they must have the practical ability to exercise the right. Now, sometimes what happens is there could be barriers that prevent the holder from exercising the rights. For example, high exercise or conversion price. I have a right to buy, let us say, 60% shares in Reliance. Okay, I have a right to buy 60% shares in Reliance. I have call option. What is the strike rate? 5,000 is the exercise price. Currently, the market price is 2,500. Will I exercise? I will not exercise. Though I have a right to exercise, 5,000 is the value at which I will exercise. In the market is 2,500. I will not exercise. Similarly, if there are terms and conditions that make it unlikely that the right should be exercised, some very unlikely event to happen, or let us say the inability of the holder of the rights to obtain information necessary to exercise it right. I have the right to buy Reliance shares, but I don't have insider information. If you would have followed, they suddenly bought back, shares which are held by Reliance retail shareholders. So I don't have such kind of information. So because of this, I will not exercise the right. So practically, though I may have legal right, I do not have a practical ability to exercise the right. And you will always look at the substance over the form. You will always look at substance over the form. So, to summarize, this is that will help you understand. If investor has substantive right, and other parties have protective right, then investor has the power. Means I have substantive right, you have protective right, I have the power. Second, I have protective right, you have substantive right, you have the power. Third, I have substantive right, you also have substantive right, then I need to evaluate further. Means who is in a position to exercise the right. Now, a lot of cases you would have seen franchisees, right? Now, what are franchisees? You see a lot of outlets, right? McD outlets, Domino's, Jockey, and all of those. Those are franchisees. Now, franchisees, does the franchise owner control the franchisee? That is the question. Now, here what you need to evaluate is, what does the franchisor control? See, normally if you see MACD, okay, if MACD has a franchisee, what does MACD say? MACD will say you can sell this type of burger. This is the place from which you have to source from. Apart from that, day-to-day operations, marketing, the way they have to put the store and all of that, that is up to MACD, right? So franchises, right, do not give it the ability to direct the relevant activities of the franchisee. They can give broad guidelines, but they don't have the right to direct the relevant activity of the franchisee. Okay, now if the franchisor says you have to buy a specific quality, now when the franchisor, when the owner of MACD says you have to buy specific quality, that does not mean that you are controlling, you are just having a protective right. Right. So directly you cannot say that just because I am giving my brand name, the franchisor controls the franchisee, because franchisor does not give them the right to direct the relevant activities. Then if I am the franchisee and MACD is the franchisor, I will direct the relevant activities. I have the control, hence I will be controlling the entity and not MACD. Sometimes there is a power without majority voting rights. Now when does that happen? See, what happens is, let us say I have, out of 100%, I hold 40%, you hold 30%. Both of us enter into an arrangement and you say that this 30% also can be utilized by me. So we have entered into a contract by which, in principle, I control 70%. Right? These types of control are called de facto control. So even though I am not holding majority share, I have a control because I have additional rights. Okay, so I can get right from contractual arrangements. I can get right from voting rights. I can get right because of special relation between investor and investee. So even though I do not hold majority share, I have to see whether I have control. Now, if I have voting rights, high number, if I have high number of voting rights, I will exercise the power. If the investor's voting right relative to voting rights held by other holders is high, again I am likely to exercise the power. Meaning to say, if out of 100 I have 45, I may have power. Okay, but we need to further evaluate. But if I have only 20, I will not have power. Similarly, I am 45, others are 2, 3, 1, 2. Then again, I likely that I will have the power. Number of parties required to outvote the investor. Number of parties required to outvote the investor. If you need more number of parties, for example, I have 45 and you need to accumulate another 55. 111 is held by all remaining 55. I have to gather 55 to outvote. Then in that case, most likely I will have the power, because I am saying 45 in favor. To defeat me, you have to get 46. If you have to get 46, it is not easy. It is not easy. So I am likely to have power. But if you need only 2, then I may not have power. Right. Then sometimes what happens is, investor can appoint investee's KMP who can direct the relevant activities. Investor can direct the investee to enter into or veto any changes or significant transactions for the benefit of investors. Investee can dominate either the nomination process for electing members of the governing body or obtaining proxies from other holders of voting rights. So basically, I can appoint someone on the board. I can appoint the key managerial personnel. Then I have the veto right, based on which I can decide something for or against. KMP are related parties. These are all additional consideration. See, this does not mean that just because I can appoint one person on the BOD, I don't have control. But let us say, if I can appoint 5 out of 9 on the board of directors, then I can have control over the entity. Okay, so that is where you will evaluate control. So important aspects what we understood here is substantive versus protective right. Substantive right gives control, protective right does not give control. Substantive right gives control, protective right does not give control. In case of franchisee arrangement, franchisor does not have control. Then first we said there is power, second we said there is ability, of course there is variable return. Now what is this variable return? Variable return, as I said, that the return that I am exposed to is variable. For example, dividends are variable, value of my investment is variable, remuneration for servicing investees asset. So if I am getting some remuneration for managing asset, then also that it could be variable, or any residual interest at the time of liquidation, this is also variable. Future liquidity, can I get future loan, that is also variable. So any of these returns can be variable which the investor is exposed to. Now how is this future liquidity variable? See, in the market, if I can get loan here, if I can get loan at a lower rate, that is also benefit for me. So that is also a form of a return, right? So an investor controls an investee if the investor not only has power over the investee and exposure or rights to variable returns from its involvement with the investee, but also has the ability. So I have power, what I wrote here, I have power, I must have ability to use the power to influence my variable returns. That is when we have control. So while evaluating control, I have to see what rights do other parties have, what kind of remuneration I am getting from the investee, and exposure to variable returns from other interests in the investee. So broadly, this part, what you need to understand is power, ability, variable returns. If it is present, there is control. And if there is control, once you control the other entity, or once the investor controls the investee, then the investor will be the parent and the investee will be the subsidiary, and the consolidation process kicks in. Exceptions to consolidations we have already discussed, and all the major areas of consolidation process. How do we consolidate? The net assets consolidation, elimination part, chain holding part, intercompany transactions, all of these we have understood. One thing what I can tell you is this is much simpler than what you understand as a consolidation process at the CA intermediate level, because here you just need to calculate goodwill on the date of acquisition, and remaining all analysis of profits and all of that is much simpler as compared to earlier. Now here important questions, blue heavens questions, all of that you have to complete, practice once again all the 3 varieties. Then there is a question which talks about chain holding. Chain holding is also important, and must practice all the previous years question papers on consolidation. Most of them are similar. So both business combination and consolidation, treat them as a single unit and practice them together. In tomorrow's class, we'll continue with Ind AS 111 that deals with joint arrangements, and then we'll subsequently talk about investment in associates, accounting for joint venture and related aspects. Any questions? Okay, thank you. Thanks for the confirmation. See you again tomorrow at 7:30 again, and we'll start with Ind AS 111 and we'll continue from